Hi, everyone. Thanks for joining us for the monthly edition of What's Trending in CTA, Simplify's Managed Futures Strategy. Per usual, I'm joined by Charlie from Altus Partners. And
Hey,
so we are going to recap October and give you a little bit of backdrop to September and some recent positioning and performance, and then just give a little overview of what's going on out there in the world of trend following. So let me start by sharing my screen. And Charlie, can you confirm? Yeah, I'm showing the right screen this time?
here we go.
All
I see
right,
it.
I have learned. So we will jump right ahead. Just diving into the big picture, of course, before we get into some of the details. I think it's always helpful to put in perspective, kind of over a full cycle. What has CTA delivered for investors? First and foremost, attractive return. We've annualized a return of about 8.4% since our 2022 inception. So really strong, attractive, high single-digit returns. But more importantly, the benefits of holding managed futures in the portfolio alongside traditional stocks and bonds is their diversification properties. And so you'll see here from a correlation perspective, since inception, CTA has delivered a negative correlation to both stocks and bonds, which is very attractive, negative zero point 0.2 correlation to the S&P 500 and a negative 0.36 correlation to the Bloomberg Aggregate Bond Index. I will highlight, of course, we do have interest rates within CTA, so there can be times we might be long interest rates, and of course, short interest rates as we have been for most of the life. But really focusing on that negative correlation or low correlation to the equity beta of the portfolio is one of the core objectives of this strategy, which we have delivered on. And then in addition to interest rate exposure, we also have commodity exposure. And I highlight that because you'll see here we've had about a zero correlation to the Bloomberg Commodity Index since inception. So despite the fact that we have long and short commodities in this strategy, CTA offers a very diversified or differentiated source of commodity exposure if you do have a static kind of standalone long only type commodity allocation. Adding CTA to the portfolio can still provide additional diversification properties. And then maybe lastly, oftentimes when we talk about managed futures, it's the benefit of having this alongside your equity beta when equity markets sell off. And so just highlighting since inception, in months when the S&P 500 has had a positive return, CTA has delivered about 0.3%, which is attractive. CTA is not necessarily meant to outperform the S&P, but its ability to keep up over time, I think, is attractive. But more importantly, when the S&P 500 has had negative monthly returns, the average return of CTA has been positive 2.25 approximately. So really attractive kind of asymmetry and the upside potential of this being a bit of a risk-off tool within the portfolio. Again, just highlighting the underlying markets that CTA invests in. And next month, we may have an update on some expanded list of markets here, but focusing, of course, just on interest rates and commodities. Very intentional that equity and FX was excluded from the construction of CTA at inception. And you'll see for rates, we have both US and Canadian rates, and then a list of kind of broad commodities. And just reminding our audience that one of the key differentiators of CTA is the unconstrained approach. And so for commodities in particular, a lot of strategies in this space might be sector constrained. The list you'll see here is kind of a blank canvas. And so we'll talk a little bit about some of the dynamic positioning, but just wanted to reiterate that. This is showing you back to the inception of CTA in early 2022. CTA is the white line. US centric 60/40 portfolio is the orange line. And really, what we like to highlight in the visual, I think, that comes through in this chart is the zig and the zag. So, having CTA alongside a 60/40 portfolio, you can see the benefit of that when the 60/40 portfolio sells off. Historically, CTA has really shined. And so, it's those kind of differentiated return properties, I think, that make this really attractive. And so, just wanted to highlight that as a reminder. And then just speaking about some of the recent performance you'll see on the far right, quarter to date returns. So from the end of September through the end of October, so just 1 month period we're showing here. The white line again is CTA. You'll see a bit of a sell-off mid-month, and we'll talk about that on the next slide. relative to the SocGen CTA index, which is the widely utilized benchmark in the trend following space. But again, zooming out, thinking about kind of some longer term return and risk, you'll see per Morningstar, CTA still has a 4-star rating as of the end of October. And for the trailing 3-year period, we're in the top quintile amongst our trend following peers. There's about 62 funds in that category. So still delivering really attractive long term return potential. But maybe we'll dive in to explain some of the recent performance and some of the kind of drawdown that we saw in the back half of October. And you'll see in the top left, the month to date and quarter to date statistics on this slide are, of course, going to be the same. It's just the month of October. And so you'll see that much of that negative 2.23% that was realized for October was driven by the commodity exposure. Rates positioning was really neutral for overall performance. And so a lot of the drawdown came from commodities. So I will stop talking and I will let Charlie join the conversation here and give us a little bit of a rundown of what drove some of that performance detraction.
Yeah, we've been pretty quiet in interest rates by and large. Really, October was all about counter trend disruption in the commodity markets. We had a pretty crazy move in precious metals, really kicked off by the perception that the U.S. and China were going to de-escalate trade tensions, and it's been an amazing run in precious metals, base metals too, to a lesser extent, but really in gold, silver, platinum, palladium. Things have had a great year. I mean, it's been wild, and I think positioning just got a little bit big. And so, when kind of that diversifying away from the dollar, being long global tension bid gets softer, it just catalyzed a position wash, and it got pretty crazy in the precious metal market. As a result, we're probably a little bit lower in terms of sizing now, but also the there was a drawdown. Now we still had from the peak of mid-October performance. Now it's still been a good strong sector for the month. But really the real fireworks were in the cattle market. And again, it's this yet again another story of the United States trade policy. And there's been ongoing discussion potentially about re-allowing imports of cattle from Mexico. And then as part of the Trump administration's bailout of Milei's government in Argentina, for what appeared to be political reasons, there was some discussion about allowing Argentine beef imports into the United States. And that, we've had this really strong uptrend in live cattle and feeder cattle prices for quite some time. And this concept of like new supply coming into the system, again, caused a pretty wild and disruptive position unwind in the cattle market. So that is really the episodic drawdown inside the month, and it's really a story about cattle. Now, to a lesser degree, we've seen some volatility in the nat gas market as well, which has been kind of trading sideways and choppy, and that has also not been great for trend following. But I'd say like the fireworks of the month were really in live cattle and precious. Now, we weren't that big in precious metals, but in live cattle, the CTA strategy did have a decent position, and that's what drove performance. Now, on a positive note, and interestingly, we've done okay on sugar over the month. There's just been a persistent downtrend in sugar as it's looking like corn is becoming more viable as feedstock for ethanol production. So there's some discussion about substitution of corn into ethanol, and that's going to incrementally reduce some demand for sugar. And then, interestingly, we've done okay in grains over the month, and recently we've swung long, and that's because the market is starting to get stronger on the back of this idea that with the possibility of trade détente with China, the Chinese may start re-importing soybeans. And so we started building up a grain long there, and it'll be really interesting to see over the next month how that plays out. But fingers crossed that we get a nice trending move.
Yeah, super helpful. Thanks for all that insight. And just to reiterate, even though we've talked about cattle being a bit of a drawdown in the back half of October, I just want to confirm and reiterate that cattle has been a huge driver, performance tailwind for the year-to-date period. And so just kind of re-highlighting that, what can be a short-term detractor can be a very long-term contributor, and that's
Yeah, it's also
prime
it's actually
example.
probably worth yeah, it's also probably worth on that note mentioning some of the differentiation of the CTA strategy versus just the SG trend index and trend replicator type products. CTA very explicitly excludes equities. And the uptrend in equities has continued throughout October. And that may also the fact that the CTA strategy is not including the equity index sector will have contribute a little bit to some incremental underperformance in this month. Now overall, that's I think been a really helpful design choice for this system because it has helped it be less correlated
Yeah.
to equities, but we paid the price for that a little bit locally on a relative basis just over the last couple of weeks. Now, interestingly, in November, stocks are getting a lot more choppy, and it seems like maybe the other side of that design choice, which is it's advantageous to not be as exposed and increase that diversification benefit in the strategy. We'll see how November plays out, but so far it seems to be good not to have a big long-term trend position in stock index in this program.
Yeah, and the last thing I would mention too is thinking about the detractors column here, you'll see like oil and gas was a detractor for the month. Just want to make a couple comments on oil, kind of going back to my original comment for today's discussion was around a lot of the other kind of commodity or managed future strategies have embedded exposure or constrained exposure to parts of the market. And energy is a really large part of the underlying benchmark, whether it be Bloomberg or S&P commodities. And so the fact that we've had small positions or even negative positions or short positions to oil, it's been a very large tailwind for us because oil has been essentially deflationary for quite some time now. Oil just had a bit of an up blip in the month of October. And so some of our peers really benefited from having that kind of static energy exposure. So I'm less concerned about that short-term kind of performance headwind, but I just wanted to highlight again the nuances of this being a long-short strategy and just some of our differentiators versus peers.
Yep.
Okay, great. So let's jump on to the next slide then. This is going to just show the overall notional exposure with the commodity notional being the black line on the right scale and the gold line being the interest rate notional exposure on the left scale. And the reason those two are separated is just from a volatility perspective, the notional exposure on interest rates is much greater oftentimes. So we put two different axes on. But you'll see it just kind of the trend I wanted to point out twofold is this kind of downshift in the notional exposure to commodities starting at the beginning of the third quarter, kind of through the end of October. And just the choppiness that we've seen in the commodity market due to a lot of the tariff announcements. So we've kind of seen exposure overall in commodities start to scale down. And then on the reverse is thinking about interest rates. We had been quite short interest rates in July and August, and we really started to see some of that neutralize into September and October.
Yeah, that's basically that's worth making a kind of another kind of high level point on, which is the system is kind of on the lower end of how much risk it has historically run, because things have been choppy. It's just you've seen a lot of high volatility movement. It kind of feels like we're pretty late in the precious metal trend, a little too soon to call the turn in oil. Maybe we're looking at the turning grains now, maybe, but the system indicators do not indicate we should be max sized up, and so it's kind of at the lower end of its VAR exposure at the moment, kind of waiting for better opportunities. And that's a really important kind of concept in these active trading programs that Altus builds for Simplify, which is like volatility is the enemy of compounded returns. So you're only supposed to take risk, in our opinion, if you think you have a statistical edge. At the moment, the indicators are not as strong, and therefore we're a bit smaller. When the indicators start to get stronger and the markets are telling us now is the time, the program will get a little bit bigger. And we think that that episodic changing in leverage and changing of exposure is a really important driver of value over the long haul.
Perfect. Yeah, thanks for making that comment as well.
Oh yeah, we are on the lower end of the risk taking right now.
Yeah.
Yep.
So we don't need to spend too much time on these next few slides. These slides are always available, so please reach out to your Simplify rep if you would like to get a hold of these. It just shows kind of the dynamic exposure through time across the markets in which we trade. going all the way back to inception and then going by calendar year and then some of the more recent time periods. So nothing here that we haven't already stated. And then just looking at how, again, the dynamism of the various markets can change from month to month, which is why the importance of these monthly updates was something we want to make sure we are providing to clients for transparency. And so we can see how markets are evolving and how positioning is as a result. So Charlie mentioned that soybean, the black line here is as of end of October. So soybeans from a long position definitely shot up. And we've seen cattle start to scale down as well, which was kind of driven by that mid-October
Yeah.
sell-off.
And if you look at the gold exposure there, you can see how much smaller it's gotten recently too. And again, that's a function of the volatility in precious
Yep.
metals.
Yeah, perfect.
Yeah.
So that's all the comments I had for today. Charlie, anything else that you wanted to mention?
No, we believe that the trend is likely to manifest, and hopefully we built systems that will capitalize on that opportunity when the market tells us so. Let's all hope that that the market gives us that signal and we get a couple good opportunities into year end. I think that is quite likely given the ongoing compounding effects of the shutdown and the potential for it to change one way or another. And I guess we'll see.
And I might just add, if you guys are looking for more thoughts around kind of where Charlie just ended that conversation, at our annual conference at the New York Stock Exchange in September, we had a Trend is Your Friend panel, and the panelists kind of dive into a lot of their thoughts on where the markets are headed and trend following as a strategy. So definitely go to our YouTube and check out that recording from our ETF conference. So thank you, Charlie, as always. Thank you, everybody, for tuning in, and please reach out with any questions. We're here to answer them.